Hey, good morning or good afternoon, everybody. Welcome to Wilary Winn's Virtual University. And we're really glad to have you. We're actually honored and thrilled. We have more than 250 attendees for these 6 sessions. And we actually had 7,500 hits on the website last month. So that's a record for us. We're really proud of that. So we've got a really good series of webinars. And the first is going to be on MSR inputs. And that's going to include Recapture. And I'm proud to say that the EITF actually consulted us with regard to the Recapture issue, and so we were able to weigh in on that issue. The next session is going to be on CECL and the elements of a defensible reserve. And Mike Tessier is going to do that presentation. And Mike, I think, knows what he's talking about because our models are 96% accurate and have been validated. And then finally, Cole's going to do a session on mergers of equals. And right now, we're in the midst of finishing up a merger of the 2 largest credit unions that ever merged. So he knows something about that, and it's fresh in his mind. So without further ado, I'll turn it over to Zach Garvis, Eric Knockin, and Annalise Ramin, and we'll talk about MSRs.
Good afternoon, everyone, and thank you again for joining us for Wilary Winn University. My name is Zach Garvis, and I'm joined by Annalise Ramin and Eric Knockin. Just a couple of housekeeping items before we do begin. For those of you who are interested in earning the 1 hour of CPE credit for this program, you'll need to attend at least 50 minutes of today's session. Additionally, we will be posting 4 polling questions throughout the webinar. You need to answer at least 3 out of these 4 polling questions to earn full credit. Please note, you do not need to answer these polling questions correctly. Simply answering them is sufficient. And then at the end of the webinar, we do have a survey that will launch. While you aren't required to complete the survey to earn any of the CPE credit, we do appreciate any feedback you may have. And then finally, your CPE certificate will be sent to the email address that you registered with early next week. Before I go over today's objectives, I did want to point out some of the MSR resources that we have available on our website. A lot of what we'll be covering today is also discussed in much more detail in our input assumptions and shock analysis white paper that Eric put together, but we're very proud of the broader library of white papers our team has published. These resources have been viewed and downloaded thousands of times as practical resources for institutions that are navigating these complex topics. And then lastly, following this webinar, a copy of the slide deck will be available for download. And I believe within 2 weeks, a recording of the webinar will be available as well. So today, I will be covering some of the key valuation inputs that drive MSR valuations. I'll then be handing it off to Eric and Annalise, who will cover the sensitivity analyses of these assumptions, a discussion of Recapture and its consideration in MSR modeling, and finally reviewing the accounting and regulatory requirements for reporting servicing assets. As some additional context to this presentation from a regulatory perspective, the interagency advisory focuses on ensuring the safety and soundness of MSR valuation practices. Institutions are expected to maintain comprehensive documentation supporting their valuation methodology, assumptions, and review process. Valuations must be based on reasonable and supportable market assumptions, with major changes to key inputs appropriately reviewed and approved. Since MSRs are generally considered a level 3 asset, management's judgment is especially important. The guidance also emphasizes backtesting assumptions, particularly prepayments, against actual results to validate model accuracy. Finally, institutions should use appropriate amortization methods and recognize impairment on a timely basis within the applicable reporting period. Before jumping into the valuation inputs themselves, I did want to briefly define what a mortgage servicing right is. At a high level, an MSR is the right to service a loan on behalf of an investor and earn a servicing fee in return. Servicing activities include collecting borrower payments, remitting funds to investors, managing escrow balances, and handling the ongoing administrative responsibilities associated with the loan. Because the value of an MSR is based on the future net cash flows generated from those servicing activities, there are several assumptions that drive fair value. The following slides will highlight just some of the primary inputs used in that valuation process. Begin with the loan amount. The loan amount determines the base on which servicing fees are earned. Since servicing fees are typically quoted in basis points of the outstanding principal balance, larger loan balances generally produce more fee income and a higher servicing rate valuation. As loans begin to amortize or prepay, the balance declines, which reduces servicing revenue, resulting in a lower market valuation. This leads me directly into servicing fees. Servicing fees are the contractual fee earned for servicing the loan. Like I mentioned before, these are most often expressed in basis points. Standard fees vary depending on the investor and loan type. So for example, a conventional fixed rate loan sold to Fannie Mae or Freddie Mac will typically have a 25 basis point servicing fee, whereas a conventional ARM loan sold will have a 37.5 basis point fee. Government loans tend to have different fee structures, with Ginnie Mae 1 loans typically receiving 44 basis points, and Ginnie Mae 2 loans generally ranging between 19 and 56.5 basis points. In addition to the base servicing fee, MSRs can also generate additional revenue through ancillary income. Ancillary income represents additional revenue earned beyond the base servicing fee. So this can include late fees, insurance income, and other fees that are generated through the servicing relationship or any cross-sell opportunities within the portfolio. While ancillary income is generally a smaller component of the total MSR cash flow, it still contributes incremental value. At Wilary Winn, our ancillary income is driven primarily using forecasted late fees, which are influenced by the borrower payment amounts. Those payments largely a function of the loan size, the first input I spoke on, and the loan's interest rate. We do benchmark our ancillary income input against MSR assumption surveys, which I'll touch on a later slide. Beyond these fee-based revenue streams, MSR value is also affected by interest income earned on float balances. Interest income from float arises from two sources. The first and larger component comes from loans that are escrowed for property taxes and hazard insurance. What happens is the servicer collects the escrow payment monthly, then disperses the insurance annually, as well as is responsible for dispersing property taxes depending on the state or local requirements. During the period between the collection and disbursement is when the servicer earns interest on these balances. The secondary and smaller source of float comes from principal and interest payments. Most payments are received from the borrower before or near the first of the month due date. However, under certain investor programs, remittance timing results in a delay between the receipt and payment to the investor. For example, under Freddie Mac's scheduled actual methodology, servicers remit actual principal collected along with scheduled interest on the 18th of the month. Under the actual methodology, more commonly associated with Fannie Mae, servicers remit only funds actually received. Now, in contrast, Ginnie Mae MBS require remittance of both scheduled principal as well as scheduled interest, regardless of the actual collections. In other words, even if the borrower has not made any payment, the servicer must still remit the full amount. The benefit of float may be reduced in states that require servicers to pay interest on escrow balances, which can offset, or even in some cases, fully eliminate float income. For example, California requires servicers to pay 2% interest on escrow amounts. While ancillary and float income provide incremental benefit to cash flows, MSR valuation ultimately depends on net servicing, which means we also need to consider the expected costs associated with servicing the loan. Servicing costs are an important component of MSR valuation because they directly reduce the servicing cash flows. At Wilary Winn, we generally model servicing costs as a fixed dollar amount per loan per year, rather than as a basis point percentage of the loan balance. We do this because servicing costs are more closely tied to the number of loans being serviced rather than the size of the loan. Put in other words, it doesn't typically cost 3 times as much to service a $300,000 loan as it would to service a $100,000 loan. It's also important for us to distinguish between an institution's internal servicing costs and market servicing costs. While an institution's internal costs are certainly economically relevant to the institution, fair value under GAAP requires the use of market participant assumptions. As a result, MSR valuations are generally based on market servicing cost assumptions rather than the institution's internal cost structure. To support this at Wilary Winn, we do benchmark our servicing cost assumptions to industry surveys and any other observable market data. Again, I'll briefly address this on a future slide. Beyond the cost of service performing loans, MSR valuation is also driven by credit performance assumptions. Delinquency rates, both current and projected, are an important driver of an MSR valuation. While current market rates, delinquency rates are relatively low, resulting in minimal impact to a value, a complete valuation should still incorporate the incremental costs associated with servicing delinquent loans, as well as any expected foreclosure-related losses. Now, these losses may vary based on the investor. So, for example, a foreclosure on an FHA loan may result in losses related to non-reimbursable expenses, as well as any foregone interest on servicing advances. For example, the servicer is generally going to be required to advance funds at the note rate, whereas reimbursement from the FHA is going to be based on the debenture rate, which is usually lower than that note rate. Additionally, certain FHLB programs, such as the MPF Original, MPF 125, and MPF 35, also involve loan sales with limited recourse, whereas MPF Government and MPF Extra have no recourse. Accordingly, the valuation should reflect any associated credit exposure from these transactions where applicable. Now, although delinquencies and foreclosure losses affect MSR cash flows, the primary determinant of MSR value is going to be prepayment behavior. Prepayment assumptions are a critical input in the discounted cash flow valuation of an MSR, as they directly determine the expected life of the loan portfolio. Because MSR cash flows are earned over time through servicing fees, float income, and the ancillary revenues, the timing of principal repayment is a key determinant of both the magnitude and duration of those cash flows. Faster prepayments reduce the expected life of the asset and compress cash flows, while slower prepayments extend the cash flow stream and generally increase value, all else equal. Prepayment behavior is primarily driven by borrower refinancing incentives, which are closely tied to the relationship between the loan's note rate and current market rates. When market rates decline relative to the loan rate, refinance activity typically increases, accelerating prepayments. When rates rise, prepayments generally slow. However, prepayment speeds are also influenced by loan-specific characteristics, such as the seasoning of the loan, original term of the loan, investor type, whether it's a Fannie Mae, Freddie Mac versus Ginnie Mae loan, and outstanding loan balance, as a smaller balance loan may have reduced refinance incentive due to fixed transaction costs, as an example. Given this sensitivity, prepayment assumptions are typically the most significant driver of MSR valuation variability within the discounted cash flow framework. The final key input in an MSR valuation is, and the namesake of the valuation methodology, is the discount rate. The discount rate is what is used to convert future projected cash flows to present value. In practice, MSR discount rates are typically derived using a build-up methodology, starting with a risk-free rate and adding a spread for MSR-specific risk. Because observable market pricing is limited and MSR trades are often privately negotiated, discount rate assumptions are generally calibrated using industry surveys and valuation firm benchmarks to ensure consistency with market participant expectations. As referenced earlier, there are multiple surveys in the MSR marketplace, and Wilary Winn does benchmark our key assumptions to some of these market surveys, this one as of November 2025. The results of the survey are shown here and provide a view into the current market ranges for discount rates, servicing costs, and ancillary income. Looking first at discount rates, ARMs generally price at higher discount rates than fixed rate loans, which reflects greater cash flow uncertainty. We also see a clear premium for Ginnie Mae loans relative to the Fannie and Freddie Mac loans, with Ginnie Mae loans carrying the highest median discount rate across both the fixed and ARM products. That same trend carries through to the servicing costs, where ARMs are modestly more expensive to service than fixed rate loans, and the Ginnie Mae portfolios consistently showing higher costs than conventional loans. Now, this is due to the greater delinquency exposure and operational complexity of these loans. Finally, ancillary income assumptions are also higher for the Ginnie Mae portfolios, which is consistent with the higher delinquency-related fee opportunities. Overall, the survey data shows a fairly consistent market view. As servicing complexity and credit exposure increase, so do the discount rates, servicing costs, and ancillary income assumptions. With the main valuation assumptions now established, the next section will cover some broader MSR market dynamics, including the negative convexity of MSR values, as well as some sensitivity analyses. Before moving there, though, we do have our first polling question.
So to touch on the polling questions that we've got throughout this presentation, there are correct answers. However, you do not have to give the correct answer to get CPE credit. Just so you guys know. You can answer whatever you want. CPE just wants to know that you are paying attention and are answering the questions. Additionally, we should have some time for questions at the end. So if anyone does have any questions, please put them in the question box and we will try to get those addressed at the end of the session. If we're unable to get those addressed in the session, we will reach out to you directly and we can have a chat about the questions that you have. All right. So close the poll, and the correct answer is age of the borrower. Most of you got that right. Discount rates definitely impact the value. Loan amount impacts the revenue in general, and servicing fee also impacts the revenue in general. All right. Annalise, thank you. I lost control there. There we go. So this slide shows negative convexity that typically exists with mortgage servicing rights. As you can see, the value of the asset declines more in negative interest rate shocks than the value increases in positive interest rate shocks. When we look at the extremes, when we look at the extremes in the plus 200 basis point shock, the MSR value increases by 19 basis points when compared to the base scenario. However, in the minus 200 shock, the value of the asset loses nearly 60 basis points of value. As interest rates fall in the negative shock scenarios, the relative ease with which borrowers can refinance has a big impact on the value of the mortgage servicing rights, as expected prepayment speeds increase significantly. In the down shock scenarios, the discount rate will decline to help offset the negative prepayment speed impact, but only to a point as we implement a discount rate floor in our MSR valuations. Since mortgage servicing rights are essentially a modified interest-only strip, in other words, there is no return of principal when the loan pays off, the servicer's future cash flows will disappear. As Annalise will discuss shortly, these negative interest rate shock scenarios is where recapture becomes an important part of managing your MSR portfolio and can create opportunity for your institution and your mortgage originations department. Finally, the negative convexity associated with mortgage servicing rights is what makes attempting to hedge MSRs complex. In our day 2 session on May 27th, we've invited our friends from Blue Rose Capital and HedgeStar to join us in a presentation regarding hedging mortgage servicing right assets. I hope you'll be able to join us in 2 weeks as we dive deeper into this topic. Thank you. Within Wilary Winn, we like to joke that this slide illustrates when we're liked and when we're disliked by our clients. This slide details the MSR value and the prepayment speed for an individual 30-year, $175,000 loan with a 4.25% interest rate over time. This runs from 2008 all the way through 2026. 2008, back when I had hair, sadly. Then the blue line, which is the MSR fair value, is higher than the red line. This is when we're more popular with our clients. When the red line spikes and the blue line drops, our clients don't like us that much. As you can see, in 2012 specifically, and in 2021, we see that the prepayment speeds spiked dramatically. We're up in the at or near 700 PSA, which would be more than 35% CPR, up almost near 42% or 40% CPR. We see fair values drop substantially. We've got even a 4.25% interest rate loan with a fair value near 60 basis points. Obviously, the timing of these drops correlates with significant economic events, the Great Recession and COVID, and very strong refinance activity that took place in these periods. It's not often when a 30-year loan with a 4.25% interest rate has a very strong incentive to refinance, but that was certainly the case in those time periods. With interest rates having risen since 2022 and have remained relatively elevated, we've seen very stable prepayment speeds, which leads to relatively stable MSR values. One other interesting thing that this chart shows is that the prepayment speeds have an inherent market floor. It's very rare that we see prepayment PSAs fall much below 100, which would be a 6% CPR. This is the market recognizing that although there may not be much refinancing activity, there is always some level of prepayment taking place, whether it be curtailment payments for a borrower making an extra $100 on their above their scheduled principal payment, or a borrower selling their house because they're relocating, moving to a bigger house, or other life events. This slide is very similar to the previous slide, but we've got a lot going on here. And instead of looking at a single individual loan, we're looking at a portfolio of 30-year portfolio. And what we've done here is we've broken out the prepayment speeds and the fair values by interest rate band. The prepayment speeds, as we saw in the previous slide, in 2020, really 2019 through 2022 or into 2022, we've seen very elevated prepayment speeds, with especially the greater than 6% bucket. We see prepayment speeds in June of 2021 hitting 25%. That's pushing the overall fair value of those loans less than 40 basis points. As interest rates rose again in 2022, we saw fair values recover significantly as prepayment speeds slowed. Similar to the previous slide, we've seen relatively stable fair values since 2022. However, if we look specifically at December 2025, we did see a prepayment speed spike for the greater than 6% loans, which drove about a 15 to 20 basis point decline in fair value. We did see a bit of a recovery in March, but due to this volatility, we've been cautioning clients not to be too aggressive when recording MSRs over the last few years. When rates decline, and as we all know, it's when, not if, rates decline, the loans that have been originated over the last few years that have rates above 6 or 6.5%, those are the loans that will be in the money to refinance. To do a little more foreshadowing for the clients that are on fair value and they are able to recapture that borrower and replace the paid off loan with the refinance loan, this will not necessarily be a big issue. However, if you're not able to refinance that borrower, you'll show a loss as that existing loan will disappear from the portfolio. For clients using the amortization method, it's a bit trickier. Even if you're able to recapture the customer and refinance them into a new loan, it's likely the new loan will be in a different interest rate band, and this could drive out impairment in the higher interest rate bands. So now we're going to look at a little bit of a shock scenario here. We've got a base loan that's a 30-year, $334,000 loan. It's a Fannie Mae loan, and we've got a fair value at year end of 1.186% and a prepayment speed of just over 11% CPR. We've run 3 different shock scenarios on this loan. The first being is the simple increasing our prepayment speed by 20%. So taking our 11% CPR up to just over 13.25%. That still shows a pretty significant decline in fair value as we lose 9.4 basis points or about 8% of the fair value. Now, 20% seems like a pretty significant shock in prepayment speeds, but the reality is with mortgagors being very sensitive to the interest rates, the prepayment speeds that we show, if we do a true shock of a down 50 basis points, so if rates were to fall 50 basis points from their current level, we would show a significant increase in prepayment speeds and a significant decline in the fair value for this loan. We would see prepayment speeds spike to 19%. The fair value would drop to about 85 basis points, which is about 28.5% decline in fair value. If rates fall further to 100 basis points, we see the fair value decline by more than 50%. To contrast that, we've run this same scenario if looking at a 4% interest rate loan. Many of our clients, the majority of their portfolios are from that 2020 and 2021 vintage range, with weighted average note rates in the 4% range. And a lot of times the loans in those vintages are even lower than that, sometimes even sub 3%. But this just shows you that in a 4% loan in the current rate environment, a down 50 basis point shock has a very negligible impact on the overall fair value, and a down 100 basis points, even though the change is a little bit bigger, it's still negligible. We only lose 3 basis points of value, and prepayment speeds only move up to 5.7%. Because really, from where we were at year end, down 100 basis points, we would probably put us in the 5.5 interest rate range. There's very little opportunity to refinance or incentive to refinance a 4% loan in this rate environment. The next input sensitivity we're going to look at is discount rate. So we've got our same base 30-year loan, same fair value. If we increase our discount rate, which at year end was 9.5%, if we increase that by 20%, which is a pretty significant increase, that would put our discount rate at 11.4%. We lose 8.4 basis points of fair value, or about 7% of the fair value. So as we mentioned, generally prepayment speeds are going to be the most significant, have the most significant impact on fair value. The discount rate will be second. And then the next one, we've done some shocks on some of the other scenarios, and these are much more less impactful to the overall fair value. A loan size decrease of 20% changes fair value by about 2 basis points. And why that happens, obviously, is when you think about the revenues on servicing rights, the majority of the revenue is based on the servicing fee, which is that 25 basis points for a conforming conventional loan times the outstanding principal balance. So if you reduce that loan size by 20%, you're reducing your servicing fee revenue by 20% over the life of the loan. Additionally, if we decrease ancillary income assumption by 20 basis points, we get just under a basis point of decline in fair value. Servicing cost increase by 20%, we lose about 2 basis points of fair value. And lastly, the foreclosure rate. If we double the foreclosure rate, it has a very nominal fair value increase, or fair value decrease, sorry, of just under a basis point. One reason for that is in the current environment, at least for conforming conventional loans, foreclosure rates are still extremely low. So even doubling the foreclosure rate has very little impact. If we were to look at Ginnie Mae loans, specifically FHA, those are performing significantly worse than conventional conforming loans. The impact would be much more significant on an FHA loan if we doubled the foreclosure rate compared to this conforming conventional loan. So now we're going to go into polling question number 2. And after that, I'm going to hand it off to Annalise, who's going to touch on recapture and accounting and some other items as well. So which MSR valuation input has the largest impact on the overall fair value? And as I stated before, no need to get the answer correct. But if you're looking for CPE, please just answer the question. All right, we'll go ahead and close the poll. And the correct answer is prepayment speeds. All right, take it away, Annalise.
All right, thanks, Eric. So next, we're going to dive into Recapture, one of the latest hot topics as it relates to residential mortgage servicing rights. So what is Recapture? Servicers have an ability to refinance borrowers of the loans they currently service. This intangible benefit is referred to as recapture. In August of last year, PennyMac requested clarification from the EITF related to the unit of account for servicing as it relates to recapture. As PennyMac pointed out, in the marketplace, MSR transaction prices include value for recapture estimates. GAAP emphasizes that fair value measurement is market-based rather than entity-specific. However, ASCII 860 states that the mortgage servicing asset represents a contractual relationship between the servicer and the investor, not the servicer and the borrower. Independent valuation providers point to this codification as the reason the recapture right is not included as part of the value of the MSR. However, this creates inconsistencies in financial reporting when acquiring an MSR asset at market value that includes recapture, but then subsequently excluding it when determining ongoing fair value estimates. This also brings into question whether recapture should be recognized as a separate unit of account. So in March, the EITF meeting addressed the accounting treatment of recapture and recommended that FASB add a project to its agenda to clarify the current guidance. The EITF was almost unanimous across its votes. With its recommendation, fair value measurement of an MSR would include recapture, moving towards greater consistency between market transaction and fair value estimates. They also recommend that recapture should not be explicitly defined. This allows entities flexibility to apply judgment based on their specific facts and circumstances rather than being constrained by a definition. Additionally, the proposed guidance is limited to residential servicing assets where recapture assumptions are most commonly observed in practice. The recommendation for MSRs in terms of the existing amortization guidance is recommended to remain unchanged. This focuses solely on the fair value measurement and does not impact how MSRs would be subsequently amortized. Entities would not need to expand disclosures, limiting incremental reporting burden. And lastly, the guidance would be applied consistently across all institutions, regardless of size or structure. So when thinking about recapture and modeling considerations, a refinance does two things. The original servicing cash flow ceases to exist, and a new servicing asset is created at a new balance, a new note rate with a new expected life. This new loan sale will also include an additional gain. So when thinking about adjusting valuation inputs, implicit adjustments can be made. For example, slowing prepayment speeds to end original servicing cash flows later, representing the cash flows that are expected to be recaptured. Or reducing the discount rate to represent that the cash flows are more valuable and the risk is less, knowing that that recapture incentive exists. However, there are also explicit value adjustments that can be made. When Wilary Winn models prepayments, we use an actuarial approach, assuming that a small portion of every loan will ultimately prepay. Using those baseline prepayment cash flows, we can then assume a specific recapture rate. Those recaptured balances will then be sold at a premium and a new servicing asset would be recognized. Now, the big question on everyone's mind, I think, relates back to what this recapture rate will be. And this, from our perspective, is going to depend on market indications. As we've mentioned, under GAAP, we are tasked with valuing the servicing asset from a market perspective. And as Zach mentioned, that doesn't mean that economic performance of the portfolio isn't valuable information to an individual institution. An initiative for us this year is to learn more about our clients' recapture experiences and initiatives. And while we haven't seen it in validation work with one exception, and FASB hasn't made a final decision yet, we are monitoring it and will certainly keep everyone posted. So now we're going to take a moment for our third polling question as it relates back to recapture. In your view, what is a reasonable market MSR recapture rate? So again, no wrong answers, just curious what participants think in terms of what that market recapture rate might look like, or maybe it relates back to your institution's specific recapture experience. Okay, we'll just give a few more seconds here for responses on the polling question. All right. So looking at the results, looks like most people think, somewhere between maybe 15 and 30% is reasonable, and I would agree with that. All right, so next, before we dive into MSR accounting, I did just want to touch on the Mortgage Bankers Association's most recent forecast release from mid-April, looking at both the mortgage finance forecast as well as the economic forecast. So looking ahead for the remainder of 2026, unemployment rates are projected to trend up to 4.7%. This is a level not seen since 2021 when we were recovering from COVID layoffs. Recognizing the strong correlation between rising unemployment and increased delinquency rates, this is definitely something to keep an eye on over the next year. While the Fed funds rate is expected to hold through 2027 based on these projections, 30-year fixed rate mortgages fluctuate on average about 20 basis points between 6.1 and 6.3% following 10-year Treasury yields. Based on weekly rates reported by Freddie Mac in its primary mortgage market survey, 30-year rates in 2026 have fluctuated between just under 6% reached at the end of February to a high of almost 6.5% by the beginning of April, averaging approximately 6.1% for Q1, which aligns with the MBA's forecast. Housing stats are expected to decline through 2028 due to high construction costs, and the supply strain is supporting continued home price appreciation despite softening conditions as the volatility in interest rates is impacting buyer affordability. As reported by the FHFA, HPI increased only 1.8% in 2025, a notable decrease as compared to 4.5% growth in 2024. HPI is expected to continue to slow, averaging as low as 50 basis points by 2027. While refinance volumes are expected to decline through year-end 2026, with a strong Q1, overall originations for 2026 through 2028 are expected to gradually increase. Refinance share decreases over the years shown as rates trend up, But as I just mentioned, while the rates here projected are averages, they're relatively stable, we know that the market has much more volatility. And so if rates are to decrease again, we would expect that refinance share to increase. All right, next we'll move into MSR accounting. So with the initial sale of the servicing rights asset, the MSR is capitalized at its fair value and along with the premium is recorded as a gain. Then moving forward in time, as cash is received each month, it's recorded as an offset to service fee income. For institutions that have older sold loans in their portfolio that they're maybe now just recognizing an asset for, whether it became material or whatever reason, we will typically advise clients to book a prior period adjustment to equity for loans originated in prior years. And then any loans originated in the current year, they would book that straight to income. So under GAAP, after the initial asset is recorded at its fair value, there are two acceptable accounting methods under GAAP, the fair value method and the amortization method, also known as the lower cost or market approach. So under the fair value method, the fair value is determined at each reporting period and the asset is adjusted to its fair value with the difference recorded directly through income. Hedging a servicing portfolio can be difficult, but the fair value method allows institutions debits and credits to minimize earning volatility. Institutions not hedging under fair value will experience more earnings volatility. This is why a majority of our clients elect the amortization method. It's important to note that once fair value is elected, it is a permanent election. Next, we have the amortization method. So under the amortization method, the asset is amortized in proportion to and over the period of estimated net servicing income. So technically under GAAP, amortization should be under level yield. However, we do see other ways, straight line or sum of years digits. Then moving forward in time, the asset is periodically tested for impairment. Materiality of the asset may impact valuation frequency. We have clients that value quarterly, semi-annually, or annually. And typically we're updating our amortization rates for our clients based on material changes in the level yield cash flows. As you're recording amortization expense, we recommend it offset service fee income. So as the actual cash is received and recognized as service fee income, the net between the cash received and the amortization expense is essentially your return or your yield. An institution that elects the amortization method can make a one-time election to fair value at the beginning of its fiscal year. But again, once fair value is elected, an institution is not able to then revert back to the amortization method. When thinking about impairment, and you'll see on the next slide, it's measured at the loan level, but reported based on predominant risk characteristics. So we define those based on the type of loan. So we segment residential mortgages into their own valuation, separate from auto loans, separate from SBA loans. Each type of loan will have its own servicing valuation, given the unique assumptions that are being applied to those loans. We then break down residential mortgages based on term and interest rate band. There are other characteristics that could be considered when defining impairment test parameters, such as loan size, date of origination, or geographic location. And there is a difference between temporary impairment, which is accounted for through an allowance, and permanent impairment, which requires a direct write-off. Generally, we see temporary impairment. However, for example, in 2020 and 2021, when mortgage rates hit historic lows and many of our clients were experiencing refinance activity in their portfolio to those historic low rates, as Eric mentioned, When that happens, the higher interest rate bands, because of the refinance activity and depending on the rate of amortization, it's not enough to reduce the asset on your books with the prepayment experience, therefore impairment can arise. In the case of 2020, it wasn't a matter of recapturing value into the greater interest rate band. So we did see clients that had permanent impairment. The book value, the fair value, I should say, was just never expected to recover and therefore required a permanent write-down. And so as I mentioned, you would create a separate contra account for impairment. Typically, we do see a contra account separate from amortization because impairment is recorded and released, whereas amortization is a permanent write-down. And so you wouldn't want to see things being released out of the amortization GL. This is a look at an impairment test parameter for one of our clients. So as I mentioned, we run the valuation at the loan level and then stratify for purposes of the impairment test. And it's important to note that with the impairment test, cushion in one tranche does not offset impairment in another. So for example, here, there is slight impairment in the portfolio, about $600. Looking at the 15-year greater than 6.5% category, we can see that the book value just over $2,000 is more than the fair value of about $1,800. So the $250 in impairment for that category is not going to be offset by the cushion in the other two tranches just above it. And so ultimately that $600 does flow through as impairment. However, as I mentioned, we often advise our clients to discuss materiality with their auditors when it comes to recognizing the impairment. So when thinking about mortgage servicing rights and runoff risk, there is an operational macro hedge. So as rates rise, originations slow, but prepayments slow and MSR values maintain or increase. However, vice versa, as rates fall, prepayment speeds increase and MSR values decrease. However, you should see a benefit from an increase in originations and the revenues generated from that. Additionally, institutions can hedge with positive convexity instruments. As Eric mentioned, our partners over at HedgeStar Blue Rose are doing a presentation in 2 weeks on MSR hedging. If you're interested, please join us for that. And hedging can definitely limit the impact of changes in fair value, given MSRs are negative convexity instruments. Additionally, if you're utilizing appropriate amortization methodology, said differently, if you're amortizing your portfolio to the level that it is performing, so maintaining prepayment expectations, then in theory, you shouldn't face an impairment situation as long as your amortization meets the needs of the portfolio's performance. And then lastly, Eric touched on this a little bit, but consider your recapture strategies and initiatives. A way to limit the impact of prepayments is to retain that borrower and return to the loan to the servicing portfolio. On this slide, we show an example of our basis roll forward file. This is an accounting tool that we provide to most of our amortization clients. And so when we're setting up the basis roll forward file, we want it to align with the parameters of the impairment test. So we've set the interest rate bands to be equal in the roll forward file as they are in the impairment test in the model. In this example, we've set up the roll forward file such that it ties back to the client's GL, so the MSR original basis amount. Would be the initial amount that they recorded or the amount that they have on their books when we're building the roll forward file for them if they have an existing asset. And then moving forward in time, the amortization rates are based off the projected level yield cash flows. However, Wilary Winn utilizes sum of years digits approach. So while we review and look at the level yield cash flows, using sum of years digits allows us to adjust for our clients' portfolio's actual performance. So in this example, we have about 16% amortization over the first year across the board. However, it does differ based on the different interest rate bands. So as we can see here, in the blue tables, we have the level yield cash flows derived from our discounted cash flow analysis. And so, for example, looking at the 30-year loans, the lowest interest rate loans, less than 4.875%, we can see that 12.1% of the asset is expected to be recognized over the next year. Looking at that, we've set the sum of years digits to amortize those loans over the next 15.25 years. This will result in 12.3% of the asset to be written off in year one. So hopefully that 12.3% being written off compared to the 12.1% expected to come in over the next year should hopefully help mitigate an impairment situation. Another thing to keep in mind, and as Eric touched on earlier, those low interest rate loans, even if rates do fall, there isn't really refinance incentive or prepay incentive for those borrowers. So we wouldn't expect the level yield cash flows to increase even if rates are to fall. However, if we look at the highest interest rate band, the greater than 6.875%, over 26% of that asset is expected to be recognized over the next year. Additionally, knowing that those loans are the loans that will refi if rates do fall, we want to be even more conservative when thinking about the amortization rates that we're setting, especially with how dramatic interest rates can change and how quickly prepayment speeds can change, which results in dramatic changes in servicing rights value. But amortization is over a long period of time. So sometimes when the environment changes, the amortization, even if you adjust how you're amortizing, it's over a longer period, it's a slower adjustment. And so it may be that you see impairment and then you work towards eliminating that impairment through faster amortization. So definitely a balance between what you're capitalizing loans at, how quickly you're amortizing those loans down, and dependent on which interest rate band you're focusing on and where we're at in the market. So with that, we will jump into polling question 4. I'm really curious for everyone on, if you had a choice, fair value or amortization, which team are you on? So this is our last polling question. As a reminder, you technically only need to answer 3 out of the 4 for the CPE credit. However, just in case you missed one earlier, we do have a 4th one here for you. Wow, pretty evenly split right now.
And just a quick reminder, if anyone has any questions, please go ahead and enter them in the question chat, and we'll try and get to them in the next couple minutes.
All right, looks like the votes have slowed. Pretty even split, a little bit of a win with the amortization method. Definitely a more hands-on approach, but also less volatile to the income statement. So pros and cons to each for sure. All right, so I won't take too much time and bore everyone by reading out call reporting requirements, but especially since the slide deck will be shared, wanted to include these in the deck for reference. With the FFIEC call report requirements, there are additional requirements for Federal Home Loan Bank loans. That's going to be true on the 051 or 041 call reports. So just quickly looking at this, recording net service fee income and the gain on sale of loans as mentioned. potentially needing a prior period adjustment to equity and describing that. And then lastly would be recognizing both the book value and the estimated fair value of the asset. There are additional reporting requirements under both 041 and 051, depending on if activities exceed the $10 million threshold, and for Federal Home Loan Bank, especially the credit enhanced products, so MPF Original, MPF 125, or MPF 35. We do have an additional manual specific to Federal Home Loan Bank loans. So if you are looking for more detail related to SSFA calculations or reporting or calculating anything related to the FHLB credit enhancement, please reach out. We'd be happy to answer any questions. And then lastly, I'll just quickly touch on the NCUA call report, very similar in terms of recording the mortgage servicing right asset, recognizing servicing fees and gain on sale of loans, and then any prior period adjustment to equity that might be needed. And then lastly, reporting sold loans and additional requirements for Federal Home Loan Bank. All right, I will pause there. It does look like we have one question. When will we receive the handout materials? So the materials themselves, slide decks, can be ready probably by tomorrow. The recordings will take a few weeks, so later in May, if not early June. Right, doesn't look like we have any other Q&A. I don't see any hands raised. So with that, I'll just thank everyone for attending the first session of Wilary Winn University. Next, we will be hearing from Mike Tessier presenting on the anatomy of a defensible CECL reserve. I will just remind everyone that we will need to close out of this session and enter into the new session, and all CPE requirements will reset in terms of answering the polling questions and the number of minutes attended. So thank you, and we'll see you soon.